Good day and welcome to the KP Big Picture. This is the first in our 5-part series, as we always do every 6 months. Here looking back to the year that was to 31 December 24, as well as looking forward at really some of the big picture stuff, which is really economics, politics. So firstly, we look at politics. It was a very busy year, and I do apologize. There's quite a lot of slides here, but we'll try and go through quickly. If there's anything you want to engage on, you're most welcome to do so. Okay, so of course the big deal in 2024 was Donald Trump's election victory as president of the US, but equally important was the fact that the grand old party, the Republican Party, took control of both houses, so they now effectively control Congress, and that means that between Trump and the Republican Party, there's virtually nothing they can't get through. All right, we thought we'd just touch on a couple of Trump's campaign promises. Really, because a lot of the rhetoric, a lot of the positioning, it could have a very profound effect on not only America but on the rest of the world. So, firstly, of course, lots of talk about deporting illegal immigrants. We've seen some action on that already. Also, lots of promises around tax cuts. In fact, in the last day or two, promising to abolish income tax completely, but talking tariffs. Still selling the line that you put 20% tariff or 30% tariff on goods from Canada or China, and they pay it. The reality is consumers pay it. So arguably just moving one form of taxation to another. But anyway, lower inflation is one of the big campaign promises, although we think that that might be quite difficult to do, particularly given some of the challenges. Climate change rollbacks, sadly leaving the Paris Accord, rolling back a lot of Biden era, which we believe were quite positive for climate initiatives, with this new whole mantra about drill, baby, drill. And as one of the Cent's big goals is for America to produce an additional 3 million barrels of oil a day by 2028. And then finally to end the Ukraine war. All right, so I mean, when most of us look at it, we say, if you look at that list of promises on the campaign trail, and not only making America great, but positioning them for a fantastic generation or two, it's all just rhetoric, it's politics, it's promises. But if we just play devil's advocate for a second and say, what if, just in a parallel universe, if Trump and the Republican Party was able to do this? I think the first thing that it would do, these are some of the potential positives, is it would rebase the American government expenditure programs at a more sensible level and a more sustainable level. And that's really important. Fiscal hawks like ourselves have been talking for a long time about the fact that, the spending has been accelerating a lot faster than income. That sowed the seeds of this $1.8 trillion deficit, and that is what caused, together with obviously COVID, this massive increase in American debt. So that's the first thing. The second thing is we believe it will lay the foundation for some very positive developments in terms of local economic growth. Things like manufacturing and industrialization in America, obviously with the resultant job benefits. If they were able to cut the deficit and arrest the debt growth, that of course is positive for asset markets and good for America long term. And then finally, of course, if you have a business friendly administration and president, that's good for, particularly with a positive view on tax, that's a very, very positive position for asset markets. So in conclusion, if there's a big if Trump and his administration was able to achieve this, the reality is the dominant position that America has had from a political, socio-economic, military point of view, it will lay the foundation for that to continue for another generation or maybe even 2 generations. So if he was able to pull it off, it's a game changer of epic proportion. And yes, then America has been made great again. The problem lies in the detail here. So what we've got on this slide, and a lot of these are busy, and I apologize, but on the top left, you can see that's really effectively the income and expenditure of the federal government for 2024. You can see mainly personal income tax is the biggest single contributor to income, and you can see social welfare is the biggest expense at about 1.5 trillion, followed by health, and then the interest bill, interestingly enough, at 882 billion. So the question is how Mr. Fix-It, also known as Elon Musk, as the head of Dodge, which is the Department of Government Efficiency, is going to be able to attack those expenditures, and the administration will cut tax and still manage to erode that deficit and arrest the debt growth. And in fact, Trump has been promising to reverse the debt position. So, it has challenges, and the bottom line is this is not going to be easy, particularly because of the promises around tax cuts, mainly aimed, I think, at the wealthy and at corporates. So the bottom line is a balanced budget is going to result in a very significant reduction in a lot of welfare programs. And then that obviously affects the most marginal people in society. We think that in order to balance the books, because the tariffs are not going to create an offset against the income tax that is being lost, which is really what we saw in 2016 with the original tax cuts. Our view is that in order to balance the books, you may see, those promises around tax concessions for the middle class evaporating, and they may very well end up carrying the can. We think that tariffs, which will be implemented in some shape or form, will be inflationary. It's a simple economics. You put a tariff on, the product costs more, and that is inflationary, no matter how you argue it. And that, of course, will have an effect on how the Fed sees the world. And we may very well see the Fed having reached the bottom of the interest rate cutting cycle, which was very much not what was kind of on the cards, and I think around the dot plots until fairly recently even. We think that disposable income is probably going to be hurt by this, or by the combination of all of these things. But I think, particularly cuts in welfare programs and laying the burden of funding at the feet of the middle class will not go down well, particularly because of where we've seen, some of Trump's more recent electoral support coming from. And then, of course, all of this will manifest in wage inflation, and that basically simply results in inflation generally being sticky. So if he can pull it off, it'll be, an incredible achievement, but it's not going to be easy, and it could have unintended consequences. What we wanted to just illustrate here is, Trump was promising, from the poorest through to corporates and billionaires, that everybody's going to get a better deal. And you can see it in his support. So if you look at 2016 when he ran, in the $30,000 to $50,000 income category, he got, I think it was 43% of the support, whereas in 2024 now he got over 50. So it was an 11 percentage point reversal in that $30,000 to $50,000 income category. So clearly, if these people, as well as the 30,000, there were some shifts in there under 30,000. If the lower income earners are prejudiced, that's likely to have quite an effect on the Republican Party support going into the next midterms and elections and subsequent presidential elections. Okay, so our base case for the US, we've got to try and sort of put it all into some sort of coherent argument. Our view is that Trump is really threatening telephone number tariffs, really as part of let's call it a negotiating tactic to get people to the table. We believe he will implement tariffs, but I think they will be done so in a far more systematic way, and I think the aggregate numbers will be a lot smaller. We think that, if Musk had his way, he would probably aggressively cut, but I do think that some of the other views in the Trump administration may moderate that. So the bottom line is, although I think they would like to aggressively cut some of those welfare and other spending programs, the reality is it's probably going to be a little bit more difficult in reality. So the net effect of that is that the deficit is not going to, we believe, be cut massively. We don't think tariffs are going to offset, frankly, or more than offset the reduction in taxes. So the net effect is inflation will probably rise moderately, probably maybe to around 3% by year end, obviously depending heavily on the extent of the tariffs. This will cause the Fed to pause, which I think asset markets generally won't like. We think consumer sentiment is going to be affected, or consumer spending rather. So the bottom line is that we're not going to see this economic miracle, particularly for the bulk of Americans. And we therefore think that GDP, bearing in mind that consumer spending represents over 65% of GDP, it's going to be difficult to grow that GDP number quite materially. We think US bonds are probably going to be range bound. We think that as the realization comes, we believe that maybe the deficit will not be reduced as quickly as people hoped, and that the debt will continue to rise. That'll obviously put some pressure on bond yields, but equally we have seen those bond yields move up more recently, along with a few other countries. So we think net it'll probably be an offset. So we think particularly long-dated bonds largely range-bound. And then we think that the dollar probably moderately weaker because it's really had quite a strong move over the last while, as we'll see in the subsequent videos. Okay, so that was kind of what we think Trump might be, his impact might be on the US, but what about the rest of the world? I think chaos is probably the best way of describing it. The climate initiatives are not good from a climate and an environmental change point of view. He's made it clear that he thinks other countries should contribute to NATO. NATO is a massive stabilizing force in a really important part of the world. He's already withdrawn from the World Health Program and the Paris Accord, for example. He's made his disdain, so to speak, for BRICS very, very clear. So we think it's going to be quite chaotic. Ironically, I think in spite of everybody feeling he's the strongman that can stand up to China, I think vacuums will emerge. And I think that net is going to be positive for China from a military point of view, an economic influence, and even a social point of view. Look, we spent a lot of time talking about America because it's the big one, but things are pretty choppy elsewhere in the world. You've seen quite a big jump to the right in a lot of places. Italy, Macron's snap election didn't go as planned, so there's a bit of chaos there. Germany's coalition government seems to have fallen apart. And even in the UK, things seem to be a little bit touchy, as well as in other parts of the world. You've seen, Trudeau has basically announced that he's going to be leaving. Korea saw a lot of volatility politically. Austria, Portugal's just really a lot happening. And I think generally probably summarized as a slightly chaotic environment. One generally more pro-protection, pro-nationalist, which has its own issues. If we look at the World Economic Forum Global Risk Survey, we looked at this in January of 2024, just to try and say, well, what else is out there? And you can see on the short term, things around, interstate conflict, for example, and information and misinformation is very big. But if you look on the 10-year view, 4 of the top 5 continue to be environmental issues. Quite an interesting view, and I'm not a conspiracy theorist in any way, shape, or form, but I do think that, if we can keep, in inverted commas, the Russian state defined as a pariah state and sanctioned, it actually serves quite a lot of people's interests. What we've got here is, just oil production and natural gas production by country. The bottom line is, having their oil and their gas effectively embargoed or sanctioned serves the interests of other producers. So, there's an argument to be had that, nobody's going to rush out to, remove that pariah state label. So our conclusion is that global politics in 2025 is going to be choppy or bumpy. We just need to be strapped in really tight. Right, then looking at economics internationally, getting our teeth a little bit more into it, you can see here the inflation has eased very, very nicely, from those ridiculous levels of 2022, 2023 after the Ukrainian attack or invasion. But still, as you can see, across the board, they're above target levels. So although it's come down, even if you look in the US, you've got 2.5% from 2.6, so remaining quite stubborn. And one of the things that we think is quite important is wage inflation. Wage inflation remains a concern, because if you've got inflation anchored at 2 or 2.5, and you've got wage inflation at 4.5, it has a way of making that inflation sticky and actually pulling it higher over time. So that is something to watch, and it's also, of course, quite important from an American point of view, because if inflation does accelerate, that wage inflation pressure is going to build, and then that could really have sort of second round effects. Very quickly, a word on the UK. We haven't spoken about them much of late. Feeling a little bit vulnerable. I think generally a sense that Labour is going to spend. The economy maybe hasn't been doing fantastically well, so their spending deficits will grow, borrowings will grow, and you saw that in a bit of a blow-off quite recently in UK debt. All right, then China is, of course, as always, the wild card. I think our conclusion is that China really needs to kickstart that economic engine. We've spoken before, we're not entirely sure what the stall speed is for Chinese growth. It seems to have held this 5% mark for a while and been able to sort of chug along, in inverted commas, relative to everybody else who is delivering 1.5%, 2%. But it would be great to see Chinese growth accelerating back to sort of the 6% mark. And a lot of stimulus programs, a lot of intervention has been announced to try and do that. And as you can see there, inflation is not helping. You can see GDP growth sort of, just trending along at around 5%. Consumer confidence has really imploded. And of course, the property market there is one of those factors. So we know that Xi Jinping is trying with his administration to do everything they can to, spur spending with, incentives and all sorts of things. We hope that takes root, because the reality is China is important. And I think, you kind of assume everybody knows why we would say China is important. But I think first and foremost, China, as we'll see in a minute, accounts for over 30% of aggregate global economic growth from the 2014 to 2024. So almost a third of total growth was thanks to China. And we need to remember that this includes that very difficult COVID period. About 65% of countries, so 120 out of 190 odd countries, would have China as their single biggest trading partner. It's becoming increasingly influential from a political and a military point of view. It's becoming an increasingly important player in technology. And you've just seen, DeepSeek as an example over the last few days. And then, of course, for countries like South Africa, it's such a big consumer of commodities that, when China is growing fast, it has a very, very positive effect on the whole emerging market cluster. This is what I was just talking about. If you look at aggregate growth, I've just taken a few countries here, some of those that are more meaningful. Chinese growth still around the 5% mark, along with India. And those two, as you'll see in a second, if you look at aggregate contribution to GDP over 10 years, those two were the standout performers, with the US coming in, ironically, at third. But the bottom line is that if you look at 2025, growth is looking uninspiring. If you look at the average of the US, Japan, Europe, and the UK, you're probably looking at around 1.25% for the next year or two, and that's with some level of forecast risk if tariffs, for example, have a destabilizing effect. So for us, the key takeaway here, obviously, anemic growth in the developed economies, but increasingly emerging economies are doing their part at driving global growth, and we believe that trend will continue. So what we were just talking about, China and India's aggregate contribution, between those two, accounting for a little under 50% of total growth over the 10 years to 2024. If you add America to that, over 55% of total growth. So China and India increasingly are very, very important as you can see there, in aggregate, China delivered 3 times or more than 3 times the level of aggregate GDP growth contribution than the US over that period. Technology, you have to address it when you look at the big picture. I think all we would like to say now is that it's a disruptor, no doubt. It's redrawing the battle lines from an economics and a political point of view. Our big takeaway, of course, is the AI rally, which we thought was somewhat unsustainable, somewhat very unsustainable, has created valuations that make markets vulnerable. We've spoken before about the Magnificent Seven and the Fabulous Five and all that. The reality, though, is AI is a powerful force. It's going to disrupt labor markets, but it's not going to be smooth sailing. And we think that it actually does introduce, from an asset market point of view, actually quite a lot of risk. Of course, technology is also important in terms of the battle lines that have been drawn between the US and other countries, particularly China, making it difficult or impossible for China to actually utilize some of the technology in the hope to hold them back. And that seems to have sort of not quite worked if you look not only at DeepSeek, but other places where, China has leapfrogged in terms of 3G and even in terms of, chip technology, although still generations behind, they've made some very, very impressive gains. So ironically, preventing China from having access to certain technology has spurred a massive investment in R&D and development with quite a lot of results. So that may have some very serious unintended consequences. And DeepSeek is obviously the new talking point, but it is pointing to the fact that China has capability and it can actually leapfrog. And when that happens, it has unintended consequences on the geopolitical level as well. And then, of course, cyber risk and disinformation are a big deal. Looking to the local picture, I'm going to go through some of these very quickly. If you look at local politics, I think the big story in the more recent past was just around the tensions in the GNU. And in fact, we held this video back in part to see what the Trump administration was going to do, but also just to try and get a sense of following the signing of the expropriation without compensation bill, what the GNU fallout was going to be. And so far it looks as though it's sticking. But I think the other moderately interesting thing is MK, after a phenomenal showing in the general elections, particularly in KZN, it looks as though that's not quite translating into local wins in terms of the by-elections. So it looks as though MK's influence may be diminishing slightly. The big story, we think, is probably provincial and metro politics, which are messy and confusing, and that's resulting in some dysfunction in some critical metros. And then, of course, also sadly, we've seen a lot of unrest and turmoil in Mozambique, and I think that we've seen it in a couple of listed companies and the impact that that's having. It's not all bad, though. I think recently sat in a webinar where somebody was just unpacking, a lot of the behind-the-scenes good that had happened at Transnet, Eskom, and the extent of the policy reform and this kind of new era of public-private participation that government seems to be advocating generally, but specifically at the SOE level. It looks and feels as though we made some good progress on the grey listing. Talk of us emerging from that grey list relatively soon. Food inflation has moderated. That's been good news. Inflation generally has moderated. The rand, although it was a bit choppier since the Trump election victory, generally has been a little bit steadier. And I think most people would agree that the mood in South Africa has actually been a lot better, since June of last year. On the short term, I think the big thing is the GNU needs to hold together, because if that doesn't, then all bets are off. We then move into uncharted territory. I don't think our founding fathers actually ever anticipated a scenario where the ANC would get less than 50%, so there was never really a need to provide for it. That creates some level of chaotic implications. And it's also, I think, important to say that because of the nature of the political landscape, it's quite difficult to get a coalition. There are very few permutations actually to get to that magical 215, I think, or 218, I guess, or 205. Anyway, so it's very important from the short-term outlook that the GNU holds together. If it does so, and we're able to build on some of the policy reforms, as we'll see in a second in some of the scenarios, could actually unlock a very, very positive future. Speaking of which, in the old days, Clem Sunter used to have the high, low, middle road scenario. And we get the feeling that South Africa is actually somewhat at an inflection point. If we do the right things, we could actually tee ourselves up for a very, very bright future for many, many years to come. If we mess it up, it could sort of spell a low road, at least for the next 4 years, until we're able to put a new functional government together. So, if you look at the business as usual scenario, that's SA GDP, grinding along, is no better word, at 1%, unemployment rising, it's just really a fumble along. I think if the GNU were to come apart, we think that would be chaotic from a political point of view, but also very importantly from an economics point of view. It'll obviously be negative from an asset market point of view, but more importantly, I think it'll accelerate unemployment, and it'll introduce more currency volatility, which is more inflation, and just makes a more difficult operating environment. But there is another scenario. We're so programmed as South Africans to sort of expect the worst because of this very difficult 10 or 15 years we've been through. But there is another scenario, which is, and it's not even a wild high road scenario, but it's a scenario where, as President Ramaphosa has been aiming for sort of 3% or commitment to 3% GDP growth. Now, it sounds elusive in an economy that's been doing 1 or thereabouts for many, many years. But as we're going to illustrate in a second, that is a realistic scenario, particularly if we can bridge the trust deficit between public and private, and we can mobilize some private capital and hopefully some developmental agency and government agency capital. Okay, so this high road scenario, we're not even talking about a high road. We're talking about a 3% where we make a modest contribution to job creation. The first thing that can help that happen is, obviously, if this is all based on a GNU and a functional political environment, if we can just accelerate the public-private partnerships, which are already working. Corporate SA has got balance sheet. The likes of the PIC and development agencies have all got balance sheets. So, capital is actually not a big problem. We've got an incredible financial system. I think the bottom line is that, we can, subtle shifts, we can move from a vicious circle into a virtuous cycle. So, I think already we've seen a lot of regulatory change at Transnet, Eskom, to name but a few. If you just think about maybe targeted areas like tourism and maybe a little around mining, given our mineral richness, tourism alone could give you another 1% or 2% GDP growth off a relatively low base, because there's just so much optionality. But we're not saying this is the scenario. What we are saying is we think that the business as usual of 1% is not it. But we maybe not targeting 3, but we think South Africa can definitely get sort of more towards the 2% GDP growth with not too much effort. One of the reasons we're saying this, and I mean, maybe people would say, yeah, but we have a history of fouling it up. When you look at the aggregate contributors to GDP, as we were talking earlier, you will see that countries like Indonesia, Turkey, Egypt, Pakistan, they were some of the biggest contributors to world GDP, aggregate GDP. And many of those, if you think about Indonesia, Turkey, Poland, lots and lots of political and economic turmoil over a sustained period. In fact, the only ones that you would say that haven't been through that would probably be the US and Germany. I've removed Russia for obvious reasons from that for now. But the bottom line is that a lot of these countries, they took concrete steps to do the basics right. And once that happened, then, things fell into place. So it's not our base case scenario that we're going to emulate, a Korea or an Indonesia. But the point is that we have quite a lot of optionality. And I think we must remember that a 2-3% GDP growth environment where we start creating jobs is not as elusive as we think. All right. enough on the big picture. Let's talk a little bit about the economics, local economics. Inflation's looking good, and that's of course something else we should celebrate. Until the most recent print, which was 3%, we were actually below that lower end of the target. And obviously, another important consideration is the fact that core inflation has actually been very, very moderate. In fact, if you look over the last 10 years, core inflation, which is actually arguably the one we should be focusing on from a monetary policy point of view, has not reached the upper end of the band, the 6%, once in the last 10 years. Inflation itself, which obviously includes the more volatile items of food and fuel and so forth, and energy, those are a lot more volatile. But the point that I'm trying to make here is that core inflation, when you strip out those cost push factors, has been a lot more tame over an extended period of time. And maybe there's an argument, while the whole country is debating, inflation targeting and the role of the Reserve Bank and what the new target should be in the, this is a worthwhile debate, maybe separating cost push from demand inflation. Obviously, as inflation has come down, interest rates have come down, but we feel, quite frankly, too slowly, and we're very fearful that the inflation may actually start accelerating, before the SARB is actually done doing, in inverted commas, what they should have done. With prime at 7.75, it has really not come off nearly as much as inflation, and it really is our hope that the SARB take the opportunity that has been presented with inflation at the lower end of the band and no real inflation in the system to cut interest rates. Really, we believe that will have a very positive effect on economic growth as well. If you look at government finances, generally looking quite good, and national finances, the balance of trade is looking very positive, in part thanks to metal prices, but also obviously oil prices that have come down. And you can see the current account deficit, obviously, which brings through interest payments and so forth, has also narrowed quite considerably. So, it's not all doom and gloom for SA Inc. Equally, government spending and debt seems to, and some of the let's call it the narrative out of Treasury around the need to arrest fiscal spending, get debt under control. Not that it's out of control, but just arrest the rate of growth in debt. So a lot of good noise coming out of that as well. Also, importantly, confidence is improving. You can see both business and consumer confidence looking better, or arguably off a low base. But this is where we feel that if interest rates were maybe to track what inflation has done, it could really give both business confidence and consumer confidence a nice lift, and that again could give us another 1 or 2 percentage points in GDP growth. Growth forecasts, if you look at trading economics, you can see that grey line is a little bit above trend. So maybe we can get to 1.7 or 2% GDP growth over the next 2 years. And possibly even better. So arguably the growth outlook is looking a little bit more optimistic than it has for some time. So in summary, the world has moved into somewhat of a protectionist phase. It's really hard to sort of say with any degree of conviction what you think is going to happen politically or economically because of the Trump factor and Trumponomics. We think that maybe rates in many parts of the world are not going to be cut much, if at all. We believe in the narrative that emerging markets will continue to drive growth. And ironically, we think that actually both from a local economic point of view and a political point of view, on the assumption that the GNU holds, things are actually looking better in SA Inc. We thank you for your time. We hope this was useful. If there's anything you want to discuss with us, you're most welcome to reach out to us. Thank you.